Live from the top of the Empire State Building. Get ready for the everyday entrepreneur experience. Sit back and crank up the volume. You're now listening to the Pest Equity Podcast.
Welcome all and welcome back to another great episode of Pest Equity Business Podcast. I'm your host, Vinny E. On episode number 42, I'm going to answer a question that was sent in about the current economic crisis and how to go about it in a business way in order to seize business advantage in this downturn. I want to thank you for the question, so let's begin. Inaction is the riskiest response to the uncertainties of an economic crisis. But rash or scattershot action can be nearly as damaging. Rising anxiety, how much worse are things likely to get? The question is, and how long is this going to last? And the growing pressure to do something often produces a variety of uncoordinated moves that target the wrong problem or overshoots the right one. A disorganized response can also generate a sense of panic in an organization, and that will distract people from seeing something crucially important, the hidden but significant opportunities nestled among the bad economic news. In this episode, we offer here a rapid but measured approach, simultaneously defensive and offensive, to tackle the challenges posed by a downturn. Many companies are already engaged in some kind of exercise like this. Certainly every organization with an institutional pulse has held discussions focusing on what it should do about the current economic crisis. I hope this episode will help you move from what may have been panic conversations and initiatives to a carefully thought-out plan. The merits of a comprehensive and aggressive approach are borne out in research by which indicates that companies whose early responses to a downturn are tentative, for example, modest belt tightening, typically overreact later on, cutting costs more than they ultimately need to. This results in an expensive recovery for the company when the economy rebounds. So my approach has two main objectives from which a series of action items devolves. First, stabilize your business, protecting it from downside risk and ensuring that it has the liquidity necessary to weather the crisis. Then and only then can you identify ways to capitalize on the downturn in the longer term, partly by exploiting the mistakes of less savvy rivals. One of my ideas in practice: before trying to capitalize on the opportunities presented by a recession, you must assess and minimize your firm's vulnerabilities. For some companies, the outcome of this process will be a program of immediate actions that represent a turbocharged version of business as usual. For others, it will be a painful realization that nothing short of an urgent corporate turnaround will suffice. Ask yourself this question: what is your exposure? The first step for a company to take in a challenging economic environment, especially one that could significantly worsen, is to assess in a systematic manner its own vulnerabilities at the company level and by business unit. Consider several scenarios as an economic crisis evolves. Sketch out at least three scenarios: a modest downturn, a more severe recession, and a full-blown depression. As defined by both duration and severity, consider which scenario is most likely to unfold in your industry and your business based on available data and analysis. There was evidence from the beginning, for example, that the current global downturn truly stands apart. Early on, banking losses had outstripped those of recent financial disasters. Furthermore, as the economy first began to stall, the underlying problem of consumer and corporate indebtedness in the United States totaled about 380% of GDP, nearly 2.5 times the level at the beginning of the Great Depression, pointed to a prolonged period of economic pain. Next, determine the ways in which each of the scenarios might affect your business. How would consumers' limited capacity to borrow reduce demand for your products or service? Will job insecurity and deflating asset prices make even the credit-worthy increasingly reluctant to take on more debt? That's the question. Will reduced demand affect your ability to secure short-term financing, or will weak stock markets make it difficult to raise equity? Even if you are able to top the debt and equity markets, will higher borrowing costs and return requirements raise your cost of capital? Quantify the impact on your business. Run simulations for each of these scenarios that generate financial outcomes on the basis of major variables, including sales volume, prices, and variable costs. Be sure to confront head-on what you see as the worst-case scenario. For example, what effect would a 20% decline in sales volume and a 5% decline in prices have on your overall financial performance? You may be surprised to find out that even in the case of a still healthy company with operating margins before interest and taxes now of around 10%, such a decline in volume and prices could turn current profits into huge losses and send cash flow deep into the red. Conduct a similar analysis for each business unit. Next, quantify how your balance sheet might be affected under the different scenarios. For example, what will the impact be of asset price deflation? To what extent might lower cash flows and the higher cost of capital affect goodwill and require write-offs on past acquisitions? Will falling commodity prices cushion some of the detrimental effects? Assess rivals' vulnerabilities. Of course, none of this process should be carried out in a vacuum. Your industry and the location of your operations around the world will help determine how your business will be affected. It's critical to understand your own strengths and weaknesses relative to those of your competitors. They will have different cost structures, financial positions, sourcing strategies, product mixes, customer focuses, and so on. To emerge from the downturn in a lead position, you must calibrate the actions you plan to take in light of the actions that your competitors will most likely take. For example, potential acquisitions with a focus on vulnerable customer groups of weaker competitors. This assessment of different scenarios and their effects on your company and its rivals, while just the first step, will help you identify particular areas where you're vulnerable and where action is the most immediately needed. This analysis will also help you communicate to the entire organization the justification and the motivation for actions you'll need to take in response to this crisis. The third question, how can you reduce your business exposure? Once you understand how your business could be affected, you need to figure out the best way to survive and maximize your company's performance during the downturn. This requires achieving several broad objectives. Protect the financial fundamentals. The aim here is to ensure that your company has adequate cash flow and access to capital. Not only does a lack of liquidity create immediate problems, but it also is critically important to your ability to make smart investments in the future of the business. Consequently, you need to monitor and maximize your cash position by using a disciplined cash management system, by reducing or postponing spending, and by focusing on cash inflow. Produce a rolling report on your cash position, either weekly or monthly, depending on the volatility of your business. That details expected near-term payments and receipts. Also estimate how your cash position is likely to evolve in the midterm, calculating expected cash inflows and outflows. You may need to establish a centralized cash management system that provides company-wide data and enables pooling of cash across business units. How much spending you postpone depends on your assumptions about the severity of the downturn and to what degree such spending discretionary. Well, you'll want to be just as aggressive in looking for ways to improve cash flow. If you were facing a worst case scenario, liquidity crisis, for example, just how much cash would you be able to raise during the next quarter? One way to improve cash flow is to more aggressively manage customer credit risk. Trade credit financing your customers' purchases by letting them pay over time should be reduced where possible. Given the economic environment, buyers will seek credit more frequently and your risk will increase. You'll need to segment your customers by assigning them each a credit rating. Avoid granting trade credit to higher risk customers or to those whose business is less strategically important to you. Also, assess the trade-off between credit risks and the revenue potential of a marginal sale. This will require cooperation between people in sales and customer finance, as well as a review of those employees' incentives to make sure they're aligned with revised strategic goals for the downturn. Another way to free up cash is to look for opportunities to reduce working capital. A surprisingly large number of companies are unaware of the benefits of aggressively managing their working capital, the difference between a company's current assets and liabilities, and make little effort to even monitor it. As a rule of thumb, most manufacturing companies can free up cash equivalent to approximately 10% of sales by optimizing their working capital. This involves reducing current assets, such as inventories, through more careful management of both production and sourcing processes, and receivables through, in part, the active management of trade credit. As you scrutinize your customers' debt profiles, you should review your own as well in order to optimize your financial structure and financing options. The heyday of leverage with constant pressure from the market to operate with relatively low levels of equity is clearly over for now. You should be looking for ways to strengthen your balance sheet, reducing debt and other liabilities, such as operating leases or pension obligations, with the dual aim of reducing your financial risk and enhancing your risk profile in the eyes of investors. Be sure as well to secure financing, for example, draw on lines of credit as soon as possible to provide liquidity for day-to-day operations, holding onto any excess cash to avoid refinancing problems in the future. Meeting such needs may require some creativity in a tight credit market. For example, some companies, in renewing revolving credit facilities with banks, have agreed to forego fixed interest rates on the funds they draw down under the facility. Instead, borrowers have agreed to link the rate to the trading price of their so-called credit default swaps. These financial instruments, which represent a form of insurance against the borrower defaulting, reflects the market's perception of a company's creditworthiness. By agreeing to initially high and variable interest rates for a line of credit, borrowing companies can secure access to funds at a time when skittish banks are reluctant to lend. To secure equity capital, companies need to look beyond the market to sources such as sovereign wealth funds, private equity firms, or cash-rich investors. protecting your existing business. After ensuring that the company's on a firm financial footing, turn to protecting the viability of the business. You must be prepared to act quickly and decisively to improve core operations. Begin with aggressive moves to reduce costs and increase efficiency. Cost cutting is the first thing most companies think about. Their actions are often tentative and conservative. You need to work rapidly to implement measures using the turbulent economic environment to catalyze actions that is long overdue, or to revive early initiatives that prove too controversial to fully implement in good times. Keep in mind, though, that while speed is important, so is a well-reasoned plan. You don't want to make cuts that in the long term will hurt more than they help. For example, putting important future business opportunities at risk. Some means of streamlining the organization and lowering break-even points are obvious. Stripping out layers of the organizational hierarchy to reduce headcount, consolidating or centralizing key functions, discontinuing long-standing but low-value added activities, selling general and administrative costs, such as marketing, are also prime targets for cost cutting. As such, they can highlight the risk of purely reactive action. Companies that injudicially slash marketing spending often find that they later must spend far more than they saved in order to recover from their prolonged absence from the media landscape. Opportunities to reduce materials and supply chain costs also arise in a downturn. Now is the time to pursue a comprehensive review of your current suppliers and procurement practices, which undoubtedly will prompt new initiatives. The adoption of a demand management system, say, or the standardizations of components. In particular, consider how the downturn affects the economic equation of offshore manufacturing. Falling shipping costs could make offshoring more attractive, even for low-cost items. At the same time, a weakening domestic currency, trade barriers, and especially the cash tied up in the additional working capital required to source a product far from its market may offset any savings. While looking for opportunities to reduce spending, you'll also want to aggressively manage the top line, cash being crucially important in a recession. Actively work both to protect existing revenue and identify ways to generate additional revenue from your current business. Customer retention initiatives become more valuable than ever. Consider tactical changes in sales force utilization and incentives. Reallocate marketing spending to bolster immediate revenue generation rather than long-term brand building. While granting trade credit sparingly, also consider the possible benefits of offering customers more generous financial terms, charging them higher prices, provided you've done your homework on your own financial structure. As these initiatives suggest, you'll want to rethink your product mix and pricing strategies in response to shifting customer needs. Purchasing behavior changes dramatically in a recession. Consumers increasingly opt for lower-priced alternatives to their usual purchases. Trading down to buy private label products or to shop at discount retailers. Although some consumers will continue to trade up, they'll do so in smaller numbers and in fewer categories. Consumer product companies should consider offering low-price versions of popular products. Think of the McDonald's dollar menu here in the United States. Whatever your business, determine how the needs, preferences, and spending patterns of your customers, whether consumers or corporate, are affected by the economic climate. For example, careful segmentation may reveal products primarily purchased by people still willing to pay full price. Use that intelligence to inform product portfolio and investment choices. Innovate pricing strategies may also alleviate downward pressure on revenue. These include results-based pricing, a concept pioneered by consulting firms that links payment to measurable customer benefits resulting from use of a product or service, changes in the pricing basis that would allow a customer to, for example, rent equipment by the hour rather than by the day, subscription pricing by which a customer purchases use of a product, say a machine tool, rather than the product itself, and the unbundling of a service so that customers pay separately for different elements of what was previously an all-in-one package, as airlines have done with checked baggage and in-flight meals and entertainment. Offering consumers new and creative customer financing packages could tip the balance in favor of a sale. From my research, it was during the Great Depression, after all that GE developed its innovative strategy of financing customers' refrigerator purchases. You should definitely rein in your investment program. Most developed economies had excess capacity even before the downturn. Capacity utilization in the United States, for example, fell below 80% of potential output beginning in April of 2008. In the current economy, there is even less need in most industries to invest in further capacity. You need to establish stringent capital allocation guidelines aligned with the current economic climate if you haven't already. This may also be time to shed unproductive assets, including manufacturing plants that have previously been difficult to shut down, selling them where possible to generate cash for the business. Finally, take this opportunity to divest non-core businesses, selling off peripheral or poorly performing operations. Don't wait for better times in the hope of getting a price that matches those of recent years. When the economy was buoyant and credit was plentiful, those conditions aren't likely to return anytime soon. And if the business isn't critical to your activities and increases your vulnerability to the downturn, divest it now. My research shows a strongly positive market reaction to the right divestitures in recessionary times, and shedding non-core operations ideally will end up energizing your core business. In 2003, in the middle of a particularly acute economic downturn, 6.4 billion engineering and chemical company decided to focus on its specialty mechanical engineering business. It sold its non-core chemical and plant engineering businesses and emerged as the renamed GEA Group, a slimmed down and successfully specialty process engineering and equipment company better positioned to pursue growth opportunities in its core areas. Maximize your validation related to rivals. Your company's share price, like that of most firms, will take a beating during a downturn. While you may not be able to prevent it from dropping in absolute terms, you want it to remain strong compared with others in your industry. Much of what you've done to protect the financial fundamentals of your business will serve you well. In a downturn, my data shows that markets typically reward a strong balance sheet with low debt levels and secured access to capital. Instead of being punished by activist investors and becoming a takeover target for hedge funds, a company sitting on a pile of cash is viewed positively by investors as a stable investment with lower perceived risk. For that to happen, you need to create a compelling investors communication strategy that highlights such drivers of relative valuation. This will also be important as you try to capitalize on the competitive opportunities that a recession offers, such as seeking active mergers and acquisitions. You can further enhance your relative value if you reassess your dividend policy and share buyback plan. The fourth question, how can you gain long-term advantage? In my opinion, the best companies do more than survive a downturn. They position themselves to thrive during the subsequent upturn, guided again by a number of broad objectives. invest for the future. Investments made today in areas such as product development and information or production technology will, in many cases, bear fruit only after the recession is past. Waiting to move forward with such investments may compromise your ability to capitalize on opportunities when the economy rebounds. And the cost of these investments will be lower now as competition for resources slacken. Given current financial constraints, you won't be able to do everything, of course, or even most things, but that shouldn't keep you from making big bets. Prioritize the different options, protecting investments likely to have a major impact on the long-term health of the company, delaying ones with less certain positive outcomes, and ditching those projects that would be nice to have but aren't crucial to future success. Rethink your business models. Downturns can be a time of wrenching transformation for companies and industries. The economics of the business may change because of increased competition, changing input costs, government intervention, or new trade policies. New competitors and business models may emerge as companies seek to increase revenue through expansion into adjacent product categories or horizontal integration. Successful companies will anticipate these changes to the industry landscape and adapt their business models ahead of the competition to protect the existing business and to gain advantage. You might be asking, where do you take action? The process we have laid out should yield a list of promising initiatives, undoubtedly more of them than you'll have the capacity to launch and manage all at once. So you'll need to prioritize, carefully assessing each initiative based on several criteria, most notably urgency, overall financial impact, barriers to implementation, and risks that the initiative might pose for the business. The results will be a portfolio of actions with the right blend of short-term and long-term focus. Who is going to carry out the recession plan? We recommend that you form a dedicated crisis management team to manage your organization's response to the recession. The team will develop different economic scenarios and determine how they might affect the business, identify recession-related risks and opportunities, and prioritize initiatives designed to mitigate the risks and capitalize on the opportunities. It will then oversee implementations of the initiatives, monitoring their progress, and continually reevaluating them in the light of changes in the economic landscape. One key to success of downturn-related initiatives is rapid implementation. A formal crisis management team to oversee your company's adopting the comprehensive approach I have laid out will be not only better placed to weather the current storm, but also primed to seize the opportunities emerging from the turbulence and to get a head start on the competition as the dark clouds begin to disperse. I want to thank you all for tuning in to another great episode of Pest Equity Business Podcast. I hope what I laid out answers your question, Chris. I want to thank everyone that follows us over at Instagram. I want to thank all our new subscribers, our old subscribers, and soon to be more subscribers. Just on a note, the Facebook group has been taken down by Facebook due to their policy changes or whatever. We're working on making another Facebook page. When that happens, we'll make an announcement, and anyone that wants to go over there and follow us on Facebook, we appreciate that as well. Please share the podcast, and we will be doing a live stream soon. Thank you all again, and God bless.
Thank you for tuning in to another great episode of the Pest Equity Podcast. Be sure to share, like, and subscribe. Follow us on Instagram at Pest Equity Podcast and join the Facebook group. Have a question or topic for the show? Shoot us an email at pestequitypodcast@gmail.com.